Hello, everybody. My apologies. I've been having some technical difficulties. I am ready to start here. We'll just wait for a couple more people to drop in. I have been having some technical issues. I'm hoping that there won't be any further ones, but yeah. So I've got the chat up. Can you guys can just somebody let me know if you can hear me okay? Okay, perfect. Perfect, thank you. So I'm going to share my screen and we'll begin. If you have any questions at all, please just type them into the chat and we'll see if we can answer them as we go. So don't be shy. I do see the chat. So let's just start with a quick introduction. So this is Investing Basics. Okay. And here, I'll make this a little bit bigger. Okay, and this session is being recorded as well, so I will be posting it on YouTube later, and then I'll just send everybody a link. So the purpose of this presentation, and it's going to be in basically 3 sections, and then there'll be a question and answer. So first one is Tuesday today. There's going to be a second one same time on Thursday, and then there's going to be a Saturday 6 p.m. And then the question and answer is going to be the Tuesday, so a week from now. So it'll be basically 3 sessions plus the question and answer. So the purpose of the overall set of presentations is to give everybody who's interested a basic introduction to investing in personal finance. This is not going to give you the capability to go to work on Wall Street or Bay Street or anything like that. It's just going to give you an intro. And so we're going to cover some simple investing strategies, compare different vehicles and account types, and talk about Canadian taxation. About 80% of this is general to the US as well. 20% is going to be Canadian specific. We're going to look at becoming financially independent and saving for retirement, for kids' education, vacation, house, whatever it is. So what you should walk away from this is knowing how to begin investing, knowing the basics, be motivated to start investing. I cannot stress how important it is to start early. Okay. You can let the compounding do the work for you. So if you're 20, great. If you're 30, great. It's never too late to start investing, as you'll find out, but it's better if you start early. And I also want to motivate you to educate yourself further by becoming interested, or at least see the importance of investing. Okay, like I said, this is going to be 4 or 5 hours of this presentation and then the question and answer. You can certainly ask me the questions, as I said, just through the chat, but ask me as we go along. This is for you. So what we're going to cover is different ways of investing. I believe it'll be the third session where I'll talk about real estate and other types of investing, but most of it is going to be mutual funds and kind of stock market types of investing. Okay. So we're going to talk about the different asset types. And what I want you to do is, as we're going through this, start thinking about what you would like to use, because that's going to determine your method. So you should start thinking about, do I want to use a financial advisor? Can I just not be bothered to try to do this by myself? Or try to use a discount brokerage and then which brokerage? Okay. I believe everybody can do this on their own. Not everybody wants to. People want to use a financial advisor because they know what they're doing, hopefully. And so they have better things to do than to learn it on their own. I think everybody should be able to, but I'll leave that up to you. So by sort of making these decisions, you're aiming to pay as little in fees as possible for whatever strategy you choose. So the first question you'll want to be thinking about as we go through this is, do I want to do this myself, or do I want to use a financial advisor? And secondly, then if you do want to do it yourself, you'll need to determine, do I want to use individual stocks, which I wouldn't recommend if you're new to it. Do I want to use exchange traded funds or ETFs, or do I want to use mutual funds? Am I going to be using an RSP, a TFSA, or other types of accounts? And we'll talk about all of this. And am I going to be making small monthly purchases, or is it going to be more large lump sums? That's going to determine which type of brokerage or which specific brokerage you want to use. Okay. I'm going to introduce you to long-term investing. This is not a get rich quick. You're not going to double your money overnight. I'm sorry. That's just not how I work. I've gotten to where I've gotten by basically spending less than I earn, investing the difference, and then letting it grow over time. Okay. So that's kind of the goals. Any questions on this? Give it 1 Mississippi, 2 Mississippi, 3 Mississippi. Good. Okay. So some disclaimers and a little bit about me. This is not investment advice. If I tell you something specific, that's as an example, or that's because I'm using it. It doesn't mean that that's what's right for you. This is for education, entertainment, and demonstration purposes only, and it's not a solicitation to buy or sell any securities. Okay? I'm not giving you financial advice. I don't know you, or most of you. So I can't give you anything that pertains to you. So about me, I've been an investor for 20 plus years in mutual funds, stocks, real estate, and private equities, which I'll explain what that is in a later session. Me personally, I'm quite risk friendly, and I don't mind investing in far off lands because that's my personal belief is where I believe they'll outperform. I run a YouTube channel and a TikTok channel. They're both called Canadian Money Talk. Check them out. That's where the recording onto the YouTube is where the recording from this is going to go. My ultimate goal is to teach investing in personal finance, both to adults and high school and college students, because I think it's very important. I'm financially independent at this point in my life, and I enjoy investing in personal finance. I have a head full of facts at this point, and I like sharing it with people. So it's a hobby, and so that's why I'm here. And I'm hoping you'll take away something from this that is going to get you on your way, and it'll give you the same freedom that I have. So I kind of wish that on everybody. Special thank you to sponsors, Oak Avenue Neighborhood Society and Vancouver's Foundation Neighborhood Small Grants Program. They're subsidizing the Zoom and the meetup.com licenses. And so thank you to them. And if you have any projects that benefit the community, you can visit their websites and they'll see if they'll give you a grant as well. Okay, so with the preliminaries out of the way, let's talk some definitions so we're all speaking the same language. Okay. So stocks, also called shares, also called equity, is ownership in a company. It may pay a dividend, which is just giving part of the profit back to the investor. So main thing you need to know is stocks is ownership. A bond is a loan. You can loan money to the government, to a company, and it pays interest. All of them pay interest. Okay. Asset allocation. It's a very long term that financial advisors like to use. All it means is how a portfolio is divided between stocks, bonds, and other assets, as well as the types of stocks. So each of these asset types works differently and will be used in different circumstances. Asset allocation is the most important factor in your portfolio return. It's not whether you're paying slightly smaller fees. It's whether you're buying stocks or whether you're buying bonds or whether you're buying real estate. Okay. Okay. Index. Index is a representation of a stock exchange. I'm sure a lot of you have heard about the S&P 500. All that is Standard & Poor's, which is an investment agency, a capital rating agency, and they have 500 stocks in an index. They add their values all together. They divide them by a large constant number, and then that represents what the New York Stock Exchange did that day. Okay, so Toronto has the TSX, which is also an index. And so when a reporter says the TSX was down today, they're talking about this benchmark. It's used as a benchmark for other vehicles, and it represents the market. So if I'm telling you that a certain asset has outperformed the market, it means it outperformed this formula. The S&P 500, the TSX index, they're just a formula. Okay, so the next thing is mutual funds. So a mutual fund is a basket of investments. It could be stocks, bonds, it could be real estate, it could be gold, cash. In some cases, it could be art, that kind of thing. The word balanced, if I ever say balanced mutual funds, that means you have both stocks and bonds inside that mutual fund. So that's a special name for it. Next, we have an exchange traded fund, which I'll probably forget to say that fully, and I'll just say ETF. So that's also a basket of investments. It works a little bit differently than the mutual fund, but you can sort of think of them as synonymous. Management expense ratio. So that's a percentage of your invested assets that you, the owner, pay to the mutual fund company or the exchange traded fund company for them to administer that mutual fund or exchange traded fund. You never see the MER, the management expense ratio, you never see it deducted. It's not a line on your monthly statement. They just control the value of the mutual fund or the ETF, and that's how they basically make a profit themselves. And I'll keep the lights on and pay the mutual fund manager that makes the decisions. Okay, so that's a MER. You generally can't get away from paying it. You try to minimize it, I suppose, but you can't really get away from paying it. So when it comes to mutual funds and exchange traded funds, there's kind of two flavors. They can be actively managed. That's where a human, that aforementioned mutual fund manager, makes decisions about what assets to include. And then you have passively managed, meaning that they're mechanically chosen by some sort of a formula. So they could either follow that index, which I was talking about up here, or they could follow a certain sector. So for example, you could have a bucket of energy stocks, whether oil or solar or whatever it is. So that's a sector. That would be the energy. Okay. There might be other rules. The company has to be at least this big and must have made a profit in at least the last 2 quarters, etc. But passively managed just means it's mechanical, that there's no high-priced rock star of a PhD from Harvard making decisions. Okay, so that's all sort of about the assets. I'm going to stop for a second. Is all of that making sense? Any questions, comments? You have to be a fast typer. No? Okay, cool. All right. So let's talk about the stock market. And a stock market or an exchange is basically a place where people go and trade stocks or other assets. The New York Stock Exchange has a physical floor. A place like the NASDAQ, which is, that's just electronic. There's no physical location that you can go see and visit. Okay, so if we talk about a correction in a stock market, that's when the stock market is down 10% from a recent top. So the market's going up, and then at some point it decides to stop going up and it starts going down. That's fairly normal. If it drops 5%, no big deal, it keeps going up, nobody cares. If it dropped 10% or more, then that's a correction. You must have heard the words bear market. That's a downtrending market. I remember it by bear down. When I used to pitch, my coach would tell me to bear down. That's when you're down 20% from a recent top. So that's a bit more extreme. A correction will happen on the average once a year, once every 18 months. Bear markets tend to be less frequent. There was one, the dot-com crash was in 2001. There was another one with the financial crisis, 2008. There was one in 2018, a very quick one. And we had one in, well, last year. So you tend to remember them, and that's because that hurts. 20% down hurts. Going the other way, you have a bull market, which is an uptrending stock market, up 20% from a recent bottom. And the market is mostly running up. It's mostly in this mode. And then every so often it corrects, or if it keeps going, then it goes into a bear market. So these three are related to the market. These two are related to the economy. So recession, everybody's heard of that. That's when the gross domestic product, which is the sum of all final goods and services produced by the economy, if it's decreased 2 quarters in a row, that's it. That's all a recession is. Depression is when the GDP has decreased by more than 10%, or a recession that lasts more than 2 years. So the last one we had was in the 1930s. Since then, the central banks have been fiddling with the economy and interest rates, and they've left us out of a depression. But we've had recessions for sure. Okay. Brokerage. So brokerage, also discount brokerage, is a place usually online where you can transact stocks, bonds, and other assets. So I use Qtrade, There's Wealthsimple, which I also use. There's Interactive Brokers. There's Quest Trade, and each of the major banks has their own discount brokerage. So that's so when I was saying, if you're going to do it yourself, you can find yourself a discount brokerage and set up an account, which will be filling out some forms online. Back 12, 13 years ago when I started, I had to send in paper forms. And yeah, you can start trading stocks. And then finally, we have capitalization, or I'll probably call it cap. That's the worth of a company by multiplying the price per share by the number of shares they have out. So these numbers are sort of very subjective. So micro is if the company's under 100 million, which I know sounds like a lot, but it's not. Small is 100 million to, let's say, 2 billion. Medium, 2 to 10 billion. Large is 10 to 20. You could say 10 to 100 just as well. And then giant is anything over 20 billion. And you know, you have, I think, at least 3 or 4 companies which are over $1 trillion in basically net worth. Their worth is the price of each share multiplied by the number of shares. Okay, so that's a bit of a lexicon, a bit of a definition of terms. Any questions? Any questions at all? Everybody's good? Okay, because I will be using these terms, so I'm hoping that you're at least recognizing them. Okay, good. Okay, so let's dig into each one a little bit. So I'll call these vehicles, for lack of a better term. So first one, stock. So a stock, like we said, is an ownership in the company. They'll have a ticker. You know, I remember all of mine. Microsoft is MSFT, Apple is AAPL. It's the basic building block of everything that we're going to be talking about here. So there's generally some sort of a commission. Wealthsimple is the only one where they don't charge you a commission. Some of the brokerages might charge $10 per trade. So whether you're buying one share and it's a $100 worth of transaction, or whether you're buying $100,000 worth, you generally pay one commission amount. With most of the brokerages work that way. Some of them might still charge you per share. Okay. So yeah, it depends on the brokerage. It might also depend on the amount of assets you have with them or your trading frequency. So if you have over, I'm making this up, if you have over 500,000, instead of $10, they might charge you $7.95, that kind of thing. Okay. The stocks are bought and sold on at a brokerage. The good thing is that once you have the stock, there's no further fees. Unlike everything else that we're going to be talking about from here. The downside of buying an individual stock is that it's not diversified. You have that one stock. If the company does well, you're doing well. If the company does poorly, same thing with you. Canadians are generally limited to buying stocks on US and Canadian exchanges. Interactive Brokers seems to be the one brokerage where if you want to buy something on Hong Kong Stock Exchange, you can. So that's a standout. I'm not aware of any others. Okay. So next we have the exchange traded fund, and I'm going to call this one out as the passive. Okay. So it's shares in a bucket of stocks or other assets. Like I said, it could be stocks, bonds, combination. It could be real estate. It could be gold, all sorts of stuff. Also bought and sold on a stock exchange, and it may follow an index or a sector or some sort of a formula like we talked about before. Commission, same as the stock, $0 to $10, let's say. But now you are paying an annual MER. You are now paying between 0.05 and let's say 0.67 is the highest ones that I've seen. Fairly reasonable. The passive ones are going to be on the low side, so they might be 0.05 to 0.2%. Okay, that's just to administer that bucket of assets. The benefits are diversification, possibly with a very small amount of money. So if you're buying individual stocks, you would have to buy, 10, 20 different stocks in order to be getting some diversification. Here you buy one ETF, one ticker, and you're diversified automatically, which is kind of handy. They have low fees, like I said. Each brokerage will also have a set of ETFs that you can buy without some sort of a purchase commission. Certain brokerages will charge you when you sell. Questrade, for example, doesn't charge you any brokerage fees to buy any ETF, but they'll charge you to sell them. So they're passively managed. It's possible they could do worse than the index during bear markets. That depends on which study you read. They won't outperform the index because they're following the index, and then you're paying a little bit of an expense, and so it's always going to be a tiny bit underneath the index. Okay, so that's passive exchange traded funds. I'm sure everybody's aware of ETFs, or at least has heard the term before. Next, we have mutual funds. So mutual funds, same thing, shares in a bucket of stocks or other assets. The technical difference is that they're bought and sold overnight. ETFs are traded during the day, so you can see your portfolio changing. The mutual funds, you'll get whatever price all of the underlying assets had at the end of the trading day, and then they'll buy it for you overnight. And it usually has a code that's usually 3 letters and 3 digits, like so. Okay. Now, because they're actively managed, they will have a significant MER. Okay. So that takes away from performance. There's also usually penalties if you sell within 60 or 90 days. And this, we'll talk about this later. This is not allowed anymore. But this is a penalty you would pay for early sale as well. So be aware of that and read the fine print. They do offer the diversification because it's actively managed. You have a human making decisions, and on most brokerages, there's no commissions to buy and sell. So there's, I think it's Questrade, which charges you commissions for mutual fund purchases and sales. So they just work the opposite. So if you remember earlier on when I was telling you, know what you want to be doing when you go shopping for a brokerage, that's why. Pick the brokerage that's going to let you do what you want to do with the least fees. So that's kind of why I suggested that. The mutual funds are sort of famous for high fees. They're usually, can you buy mutual funds on Wealthsimple? I don't believe that you can. Wealthsimple allows stocks and ETFs. I don't believe that you can do mutual funds on Wealthsimple. Good question. But check with them. But I got my Wealthsimple account about 3 months ago, and I don't believe you were allowed to. So that's the choice that they've made. The salesperson that usually sells you mutual funds has a sort of a conflict of interest. in that they make commissions off of what they sell you. So that's unfortunate. We'll talk about financial advisors in a later session. I have an original warrant certificate and a copy of the share certificate that will be traded in Canada soon. Where do I take that when it's going to the market? You're gonna have to, I think you could either go to the, and this is a fairly technical question. I think you could go to the company itself if you contact their investor help line, help email. You could try them, or if you get a discount brokerage, you might be able to get a hold of their service desk, and they might be able to help you out. I bought warrants myself, and I ended up going through the trading desk at Qtrade, and it was a bit of a hassle. I had to fill out a form, and then I had to transfer extra money to execute the warrants. So yeah, your brokerage should be able to help you out, or the company whose warrant you have. Yeah, good question. Whatever brokerage you have, whatever brokerage you're using. If you don't have one, try going to the company. Well, yeah, then try going to the company, contact their investor relations and see if they can help you. Otherwise, get yourself a brokerage and use their trading desk. It's a bit more than you would want to deal with normally. So, and so the last one, who do I suggest? I think if we go through the presentations, you should sort of get an idea, as I said at the beginning, of what you want to be doing. It sounds like you're into stocks already, so you would want to choose a brokerage that charges you the least for stock transactions. That's what I would suggest. So Wealthsimple charges nothing for Canadian, so I would start with them. They'll for US stocks, though, they will charge you 1.5% for the currency exchange, and they don't have a US account. They only have a Canadian account that you're holding US stocks in. So that's why I said I only do Wealthsimple for Canadian stocks. Yeah, you should determine what you want to be doing, and then find a brokerage that will let you do it the cheapest, basically, because the fees do add up over time. Okay, so the last type of vehicle would be a mutual fund, but that is following a passive index. So that's very similar to the ETF that's following a passive index. And so same thing, it's shares in a bucket that follows an index. Everything else is the same. The MER is going to be lower than the actively managed mutual fund, but it'll be higher than the ETF. And same thing, diversification with a small amount of money, and depending on the brokerage, most brokerages won't charge you a commission to buy or sell, and it'll be passively managed again. So there you go. Okay. Any questions? These are kind of, if stocks and bonds are kind of the basic building blocks, the mutual fund and the ETF are kind of the one level. Where can you buy are the one level above? Where can I buy mutual funds? Through your brokerage. Through your brokerage, or if you want to use a financial advisor, your financial advisor will make you fill out stuff. Which broker offers what? Most brokers will offer pretty much all of the mutual funds. They might filter it. Yeah, Wealthsimple doesn't do mutual funds. They might filter it to certain ones. certain families might be excluded. Certain mutual fund families might be excluded. If it's a discount brokerage, they will make sure that they have the do-it-yourself mutual funds. So those would be the ones you should be looking at, because they have lower MERS, because they don't pay a commission to the financial advisor. Questrade should, yeah, Questrade should let you do mutual funds. I believe though that Questrade is the one discount brokerage that charges you trading commissions for mutual funds. So if you're going to use them, don't buy a mutual fund for, you know, $500 once a month, because the fees end up being expensive. TD, CIBC, BMO, yeah, all of them will do it. Yep. Okay, let's talk about risk, the proverbial four-letter word. So before you start buying anything, you should be well aware of the risks on two sides. Your own risk friendliness, I'll call it. And let me see if I can move this down so I'm not looking up. Can I move this down? Maybe not. That's a little better. You should know your own risk friendliness and be aware of it, and the risk that the asset that you're buying is has, basically. So your risk appetite is basically your ability to handle volatility. And volatility just means ups and downs. Risk, same thing. It just means up and down movement of an investment. So different investments, different vehicles have different risk profiles. Okay, so you need to be able to handle it psychologically, the volatility, the ups and downs. Are you going to freak out if you see a statement with losses and then you can't sleep? If your portfolio, you look and it's down 10% for the last month, are you going to be upset? And are you going to say, oh my God, I worked so hard for that money? If you're using a financial advisor, they'll give you a questionnaire, or they'll talk to you. They'll give you 20 questions where it basically makes you pick A, B, C, or D, and they will give you a certain risk profile according to that, or they'll talk to you. Okay, if you're doing it on your own, you should be aware of what you can and can't take, and what's going to prevent you from sleeping at night. The sleeping at night is an indicator. If you can't sleep, I'll confess, back in March of 2020, my portfolio was down $600,000, and I slept like a baby because I knew it was all coming back. But other people would freak out, and that just means that their risk appetite, their risk friendliness isn't what it should be for what they're investing in. Okay. The other thing is you need to be able to handle it financially. Okay. So are you going to be selling assets that just dropped to buy groceries? If you are, then you're in the wrong types of assets. And then finally, financial education increases the amount of risk a person is able to handle. Okay. So the reason why I was okay with those losses, and in fact, I don't advocate anybody do this, but in fact, I borrowed to buy more because stuff was on sale. So if that's not your approach to investing, then you need to be in something that's not quite as volatile. Okay. Does all of that make sense? This is sort of internal to you. So you sort of need to, you sort of need to be able to gauge that. If you're using a financial advisor, they'll form an opinion either based on those 20 questions, and then they'll tell you, okay, you're sort of medium, or yeah, you're okay with high risk. Okay. Now, that questionnaire, or what they ask you, the financial advisor, it's known as a KYC, and know your client. If you're doing it by yourself, it's know thyself. I think it was Aristotle, wasn't it? So what composes that? Well, it's your risk appetite, what we talked about up here. The time frame is very important. When do you need the money back? So not everybody's saving for retirement, right? Not everybody's 20 and saving for something that'll happen in 30, 40 years. They could be saving for their kids' education, which might happen in 5 years. They might be saving for a trip, which might be in 6 months, or they could be saving for down payment for a house. So the time frame is very important, and I'll show you in a sec why. But if you have assets that are very volatile, you could get lucky and you could need to sell it on an upswing, but you could also get unlucky and you could sell it on a downswing. In which case you might not have quite the down payment for your house as you were hoping for. So now everybody thinks, oh, it won't happen to me. I'm a great stock picker. So the time frame is very important. Basically, rough guidelines. Anything over 10 years, you're probably good with stocks. If you're a little bit squeamish, right? Going back to this, that's sort of the overriding thing, because you could be 20 years old, you could be saving for retirement in 30, 40 years, and you still freak out when you get a statement that shows that you lost your money, that you lost some money. Okay. It doesn't hurt quite as much if you had up, and then you had a down, but as luck would have it, you start, and then the first thing it does is it goes down, right? So if that scares the bejesus out of you and you never invest again, that's really bad. Okay. Most people like to think, oh, as long as I'm up overall, but yeah. So time frame, and then the last thing, and this is quite important, is what return do you need? So if somebody comes to me and says, hey, listen, I have 100 grand, I kind of did my financial plan and I need it to double in the next 10 years, then that's a different set of investments than if you say, I need it to double in the next 30 years. Or listen, I have $1,000, I need to have $5,000 in a week, or my kneecaps get broken. That's a joke. What do I put the money in, right? So you get different types of investments that are appropriate for kind of these three things. So the risk, time frame, and the needed return is what drives the portfolio that you would choose. Okay. So different types of portfolio. I hope you guys can see this. So this is sort of a trade-off of rate of return and volatility risk. Remember, volatility is just up and down. It just takes your money for a roller coaster ride. So there's a correlation between the amount of ups and downs and ultimate rate of return. And so here you have different portfolios. In case you can't see that, the safest one is kind of fixed income and bonds, which tend to be safer. And then, you're getting into the blue, which is US stocks. The red is international stocks. And you can see as you kind of go along here, you're all in stocks with a whole bunch of international and even more US. So that's sort of how, depending on your risk tolerance, you would choose what portfolio you would get, or your financial advisor would help with. Okay. So generally, stocks are more volatile than other assets, and generally closer to home, stocks are thought thought to be less volatile. Closer to home, you think rule of law here, but then you think about, not to pick on Venezuela, for example, but they've had some issues recently, or Russia, for example, where every so often all the investors lose their money and everything becomes state property. So closer to home is generally thought to be less volatile. So that makes it Canadian stocks, US stocks, followed by international on the volatility scale. Larger companies and their stocks tend to be less volatile than small company stocks. So small company stocks would be maybe recent startups, and they could do really well, or they could go bankrupt. And so you have a lot of up and then a lot of down. Bonds are generally less volatile than stocks, generally. If you choose, Microsoft versus a small company bond, again, I'll pick on Venezuela, I would say the bond is riskier, but that's sort of a general statement. So the more risk you're willing and able to accept, the more time you have, and the more return you need, the more volatile your portfolio can and needs to be. So if you're 60 and you want to retire in 5 years, and you need to make up a lot of time, you need to make up a lot of ground, you're going to have to put yourself into some pretty risky stuff, which could also go very badly, and it could actually have quite the opposite effect. If you got 40 years, you can put yourself into some volatile stuff, and you don't need the money for a long time. So now my personal thinking is, and this is from Paul Samuelson, investing should be like watching paint dry or watching grass grow. If you want excitement, go to Las Vegas. Okay, I don't really buy anything that's going to be anything too risky, too up or too down. So there you go. So where are we going here? Okay, so some rules of thumb. So equities in your asset allocation. So this is basically how much stock should you have as a part of your portfolio. So some experts say 100 less your age. So if you're 40, you should have 60% of your portfolio in stocks and then 40% in bonds. Recently, it's become more 120 less your age. So with my 40 years old, that would be an 80-20. That's just a rule of thumb. Everybody has their own risk profile, and they can do whatever, whatever feels right. The other thing is, everybody feels really good when the market is going up, and they think that they're really risk aware and risk friendly. It's when the market starts going down is when you figure out who actually can take the risk and who's petrified. And they, the market's going up and then starts going down, and they're gritting their teeth and they're like, I'm a long-term investor. It keeps going down. And that's when they sell. That's when they try to make the pain go away, because they'd rather take a loss than risk everything. And the thing is, stocks don't go to zero. If your entire portfolio is worth zero, our society is gone. That does not happen. But it'll go down 30%, which is very painful. And when you're at the bottom and everybody sells, there's actually a name for it. It's called capitulation. There's like this whole curve where it has names, elation and stuff as it's going up. And that's when all the professionals go in, when everybody says, I give up, make it stop. And then the market starts going up from there. So that's at the bottom here. That's the best buying opportunity, but people don't look at it that way. There's a cliche saying, if you think the world is ending, you should be buying canned goods and ammunition. Otherwise, you should be buying stocks. So, okay. If you have a pension coming, you can sort of look at it as risk-free income when you're doing any calculations for retirement. And you can subtract it from the amount needed for retirement. So that's sort of a suggestion, rule of thumb. A lot of experts say you should not use your pension in you know, as risk-free income. Yeah, it depends. So target date funds is sort of an interesting product. It basically lets you buy a mutual fund with a date when you're going to withdraw the money. And so you can buy one, you know, for 2061, 40 years out, and that's going to be all stock. And as time moves on, they're slowly going to rotate you out of stocks, and they're going to start putting in bonds. So it becomes 90-10, 80-20, and so on as time rolls. And that sort of does, they charge you for that. They have a higher MER, of course, but you don't have to kind of do your own calculations. They sort of generalized everybody and they put them into the same bucket. Those are okay, except don't forget, you don't need all of your money on the day that you retire. You're going to live, God willing, another 30 years. So you would have to have multiple target date funds for that to work. Okay, if you have significant equities, you should definitely have an emergency fund. You should have an emergency fund anyways. It should be 3 to 6 months of basic expenses, definitely before you start investing. Okay, so that way you don't have to sell something to live on after it's gone down, because if you just gotten laid off, it could be that the economy has taken a turn for the worse, and so has the stock market. So your portfolio has gone down. And while you're looking for a job, it would be nice to have cash to live on, rather than having to sell something that just took a 20% haircut. Okay. The other cash you might want to have is to buy more equities after they went down. So this is a personal decision. A lot of people like to be fully invested at all times. Other people like to have cash ready for investing, which of course isn't earning very much, the cash, but cash is king after there's been a downturn. So that's something to consider if you're, well, whether you have a financial advisor or not. Sometimes the financial advisor will suggest to put your money into term deposits, but that's not really ready to buy more equities. Okay. Any questions on all this? This is all. Everybody knew this already, or is this new information for folks? Am I skipping anything that you want to go back to? It's all making sense. I'm looking at the chat. Okay, cool. All right. Oh, good. All right. I enjoy positive reinforcement. Okay, there to illustrate some of these concepts that we've learned. There's something called a bucket portfolio. I can't recall who invented it, but one of the research websites, Morningstar, they talk about it quite a bit. It's usually used for retirement, but I think it'll give you an idea of how to set up your portfolio even prior to that, just as different types of assets work. Okay, so we're going to have three buckets. This is a strategy. This is a strategy, and it has two purposes. One, to not have inflation outpace the performance of your portfolio, and two, not to have to sell stocks after they took a dive. So in bucket one, you have 2 years of living expenses in cash. Liquid cash, it's not earning you anything. It's definitely not outperforming inflation. But what it's giving you is it's giving you 2 years for the market to start going back up. Bucket two is 8 years of living expenses, right? 2 plus 8, 10 years now. 8 years of living expenses in high quality bonds and dividend stocks, usually bigger companies. And so what these do is that's sort of your safety, but it's earning you something. And in bucket three, everything else you have is in stocks. So what does this do? Well, it avoids the inflation risk in retirement by having stocks, because those get you high returns. They're volatile. They could have those crashes, which we're trying to circumvent. But they, over the long run, will outperform everything. And it avoids you having to sell equities to live on after they went down by having cash on hand and by having those bonds. So that's sort of the strategy. If you're starting out with investing, what percentage of your income would you consider investing, and how often, assuming you already have your 3 to 6 months reserve? Percentage of your income would you consider investing, and how often? So you're asking how much of your income should you be investing? Is yes? Okay, perfect. So that all depends on your goals. Okay, if you want to retire early, you're investing absolutely everything. I worked in IT, so I made very good money. I worked contracts as well, and so I was living on 15% of my income, and I was investing the 85. That's not reasonable for everybody. I get that. What the experts say is 15% of your gross income should be going into investments. 15%, 15. Okay, that means if you started, in your late 20s, early 30s, you're good to go by your 60s. If you want to retire earlier, you need to bump that up. Basic math. Okay. Okay, so back to the bucket portfolio. So there's 2 ways to run this. I'll just go over this really quickly. One, passively, you only get the money from bucket one, and then you sort of rebalance, meaning you shift money from bucket 3 into bucket 2 and from bucket 2 into 1. That tends to be tax intensive, and so you can run it intelligently, actively, and you decide based on the previous year's bucket 2 and bucket 3 performance which bucket to pull money from. So if stocks did really well last year and they're up, pull money from bucket 3 by selling. If bucket 3 tanked and 2 is barely holding on, live off of bucket 1. And then when things get back to normal, you can sort of start the water flowing from bucket 3 to bucket 2. Okay, good question about the percentage to invest. I might cover that in a later session. Okay, so I know you guys can't read this. I can't either. I have a big one of these. I think it's like 3 by 5 feet on my wall. This is the Morningstar index chart. This is from 2017. The blue line up here is US small caps, small stocks. The light blue is large caps, US. The red is our own very own Toronto Stock Exchange. And so what this is used to illustrate is that, and by the way, if you can get your hands on one of these are great. It has who was president, who was prime minister, what the inflation was, what the price of oil was, all of that great stuff. Yeah, it's what the US to Canadian dollar exchange rate was, all kinds of stuff. Anyway, for money nerds. So the blue, and I'll read that for you, made 14% per year. And by the way, this is 1950 and this is 2017. So in 67 years, the small caps made 14% a year. It's like, what's not to like? It's upward trending. I can definitely see that. But there's a lot of bumps and bruises along the way. So if that's not your thing, you might want to make only 10% of your portfolio in this category, right? This is it amber? Maybe it's amber. So that's a bond index. Okay, you can see it's kind of going up pretty well, and then as interest rates go down a little bit, it sort of flattens out. The green line down here is treasury bills, which are also bonds. You can kind of see, you know, it's nice and flat. You're like, oh, I like that. Well, but the green line made 3.6% per year, which over 67 years is night and day. So the point I'm trying to illustrate here is that the volatile stuff will outperform everything, but it'll take your money for a ride. So if you can't handle it, then don't invest in it, or invest only a little bit in it. Okay, that would sort of be my my guideline. And of course, if you have a financial advisor, they should advise you, fingers crossed, right? So, and going back to the correlation between volatility and return. So the safer something is, the less return. Like if you want no risk, get yourself a term deposit. It's going to give you 2.5%, but nothing bad will happen, but also nothing good. So you have to be ready to take risks when investing. So can you provide an example of how long it takes your money to double based on a percent formula? Yeah, there's the rule of 72. I forget which way it goes. I have to look it up every time, so please don't make me. But basically, if you have something that's returning 10% compounded per year, it'll take 7.2 years to double. So there you go. And 7.2% obviously will take 10 years to double. Okay, so the diagram shows the risk and return trade-off. From 1968 to 1974 was a down market for US small caps. So from 1968, whatever it was, 1968 to 74, if you held this, yeah, that was a tough time. But now imagine that you were buying every month, and you kept buying, and then when it came back up, you look like a genius. So, you know, term deposits, low risk, low reward, small caps, volatile, but outperform in the long run. Okay. This is a recent addition to this presentation. I like to define things for myself. This is my own opinion. Everybody needs to get their own opinion of this. Okay. So to me, when I say an investment, I like to have a steady stream of income or cash flow. So examples would be stocks that pay dividends, that give me every month or every quarter or every 6 months, they pay me something. Investment in real estate that has a positive cash flow, meaning you have money in your pocket at the end of the year. Okay. The value of the asset is determined by a series of cash flows. So that's an investment. Speculation, and I do have investments in this category, is an asset that goes up in price because somebody else is placing a higher value on it. So stocks with no dividends, but let's say they're making a profit, but they're not paying you, the owner, anything. And therefore, there's the price appreciation. Real estate with no positive cash flow, but it's going up. So there's examples of that, I'm sure, in Toronto and definitely in Vancouver, where somebody buys real estate, it has a renter in there, but they're subsidizing the renter. Every month they have to put in another $100, $200, and they're hoping that the real estate keeps going up in price, which of course you need other people to believe that in order for it to happen. Bitcoin and gold are also in this category. You basically need other people to believe that Bitcoin is a good thing in order for you to make money on your existing investments, and gold as well. I'm not going to make any further comments on Bitcoin and gold. So the value of an asset is determined by what somebody else is willing to pay for it, but you need other people's help. And then finally, you have outright gambling, where the asset on the average is going to stay the same, maybe go up in value, maybe go down in value. I kind of rank stocks of companies that don't make a profit, and therefore they're unlikely to get any price appreciation, or real estate with no expected price appreciation. Like if you buy something 100 kilometers from the nearest town, it's unlikely that real estate's going to go up. So this is kind of my view of the world. I definitely own stocks that don't pay dividends, but every time they go up, I tend to get out of them. Okay, a little bit of rah-rah for people who maybe haven't started yet. The importance of starting early. So $1 invested for 40 years at 7% will turn into almost $15. But if you invested for only 10 years less, you get half of it. For 20 years less, you get way less. So this is just compound interest, right? It's just calculations. Importance of low fees, similar thing. $1 invested for 40 years at 7% turns into the same $15. But if you are paying a 2% MER and you're getting 5% return, you lose half. So fees are important, but I do want to note any performance that you see on a prospectus from an exchange traded fund or mutual fund is always after the fees and MERs have come off. So I would encourage you to look for mutual funds with great performance rather than just a low MER. Okay. But it's a high MER is basically adding insult to injury. These calculations, they say, well, by the mutual fund company charging you these fees, they're taking half your profit, or depending on the calculations, 2/3 of your profit, because of the way the curves go, right? You think this is proportional, 7 and 5, but it because of the compounding, it has a significant effect. So just be aware of that. That's all. Okay, so markets go up in the long run. So the S&P 500 over the last 31 years, 3 times it lost with between 0 and 10. Once it lost between 11 and 20, and so on. But far more times did it make positive returns. Okay. same thing over the last 92 years. There are definitely years where you can be down. So we either white knuckle those and don't do anything ideally, or if you have extra cash, that's when extra money goes in, because then you'll make, because stuff's on sale and you'll make more money the next year. And one more, just more green than red. There you go. Okay. This is bear and bull markets. Remember, bear is when you're down 20% from a recent high, and bull is when you're up 20% or more since a recent low. Now you'll notice a lot more bull markets rather than down. The recessions are sort of, you know, the gray slices are recessions. They're sort of interspersed in there. The markets and the recessions don't always go hand in hand. The markets will often go down before the economy actually starts feeling it. And sometimes you'll have a recession in the middle of a bull market. So it's not, yeah, they don't always go together. What I do want to point out is the lengths of these. 2.8, that was the Great Depression. 10 months, 6 months, 11 months, 2.1 years, 4 months, 1.6 years, 2 years. So if you remember that bucket one, which was 2 years of cash, this is why. The markets will, large majority of the time, recover within 2 years. So that's why the bucket one has 2 years of cash. Okay. So investing strategies. So what can we do? We can do a lump sum. That just means you have $5,000, you buy the stock, you buy the mutual fund, you buy the exchange traded fund, one-time purchase. If there's commissions, if it's on a large enough amount of money, you know, $10 isn't going to kill you if it's off of 5,000. It will kill you if it's off of $100. So that's the lump sum. So that's why I was saying, if you're planning on doing lump sums, for example, you can choose brokerages that charge you transactions fees, commissions, you know, that $0 to $10, and it's not going to kill you. Okay, dollar cost averaging, or DCA. So this is what people typically use. You buy the assets monthly, quarterly, use the same amount of money each time. Therefore, if the market's gone down in value, you're buying more. So if you're doing $500 a month, if whatever you're investing in goes down, then you end up that month buying more of it. Now, the downside is all the stuff that you bought before also went down, but you know that it's going to come back up. So dollar cost averaging is good. So you're basically putting the money in as you make it, as you earn it at work. So the word protects is quite strong here. It doesn't protect you against bear markets, against down markets. It makes you feel better about them, because during that time, for that duration, you're getting stuff on sale. It's typically used in a pre-authorized payment scenario, so the money is withdrawn automatically and the investor doesn't even miss it. So if you're one of those people, and I'm sure everybody on here is responsible and so on, and they spend while there's money in their checking account, this way, if you set something up ahead of time and you spend whatever's left over, at least you're saving for your retirement and you're okay. But if you were to push that button manually, a lot of people don't. They just don't. They spend, and it's like, oh, you know, I need that massage, I deserve it, or I need that trip, I deserve it. And every month there's a different excuse, and the years go by and you miss out on all that compounding. So setting it up automatically is a good way. If nothing else, you don't have to worry about it, other than obviously having money in your checking account. So that's what that's the basis of dollar cost averaging. Everybody uses it. Financial advisors like it because you fill out one form and you provide your bank information, your routing number and your account number, and they just start pulling the money out, and they don't have to do anything, and you don't have to do anything. So yeah, and I've got two of those going, one into my TFSA every month, and one into my corporate. So rebalancing. So rebalancing is performed every 6 to 12 months. There's no need to do it any more frequently. Or when the portfolio mix of assets has moved significantly away from the investor's risk profile. So let me explain. So when you and your financial advisor did your risk assessment and you came up with a portfolio, and let's say you came up with 60% stocks, 40% bonds, let's say, and or you on your own, you're like, yeah, I want some stability, so I'm going to put something that maybe won't perform so well, but it also won't crash. So I'm going to have 40% bonds, I'm going to have 60% stocks. And that's what you're good with. That's the amount of ups and downs that you're willing to handle. And that's what you're going with. Now, you could have done a lump sum, or you could be doing monthly purchases. And let's say you're doing 500 into each. So you would expect to have, or sorry, just for ease of calculation, you're doing $600 into a stock mutual fund, stock ETF, and 400 into a bond stock, mutual fund or ETF. And those sort of move somewhat differently. That's why you have them, for diversification as well. And so at the end of the year, you're not going to have proportionate. What is that? 7,200 and 4,800. Right? It's not going to be like that. It's not going to be 7,200 in stocks and 4,800 in bonds. It'll be something different. Most years, the stocks will outperform the bonds, and so you might have 8,000 and let's say 5,000. Okay. So now you're more exposed to risk than you want it to be by this being out of balance. And so what you do is you rebalance it. You get it back to that 60-40. That does two things. Sorry, I'm wondering if my technical issues are coming back. No, everybody's good. That does two things. It will sell high as far as your portfolio is concerned, and it will buy low. So what you will do is you will sell some of the stock part, and you will buy the bond part, okay, to get it back to that 60-40. So it'll sell what's gone up disproportionately for your portfolio, and it will buy what's either hasn't gone up as much, or maybe even it went down, and it'll buy that. So you're buying low. And the other thing is, it will get you back to where you want to be as far as your comfort level for your risk. Okay, and so it has that positive effect, and it actually does add to the performance of the portfolio. A couple of percentage points actually seem to be the studies. So think of it this way. The bonds are kind of like the safe part, and they're the piggy bank. And then the stocks are the engine. That's what's really going to drive your portfolio forward. So year one, stocks outperform the bonds. And let me say, first of all, both could have gone up, but disproportionately, or one could have gone up and the other one down disproportionately, or both could have gone down, but disproportionately, or you're worried about the lack of proportion, the 60-40. And so you rebalance it to get it back there. And so year one, stocks outperform, you take some money off the table, you put it into the piggy bank. Year two, again, stocks shockingly outperform the bonds, which they will do most of the time. You take some money off the table, sell some of the stocks, you buy the bonds. And then a day will come, my friends. And we saw that last year, we saw that in 2008, we saw that in 2018, when the stocks take a header and they lose 20-30%. And that is when you crack open the piggy bank and you rebalance the other way and you buy the cheap stocks. And that is how money is made. In all seriousness, this really works. You have to be dispassionate about it. Financial advisors, if they should do a lot of things for you, but it's sort of the primary role for them to prevent you from selling during a crash, and ideally to buy more, and to via this rebalancing. There are also ETFs that do this automatically. Yes, there are for you, like XBAL and VBAL, but they have higher MERS. Yes, absolutely. So so that's very true. You can, if you want to do one-stop shopping, you can buy mutual funds, those balanced mutual funds. Remember, I pointed that out in the definitions at the beginning. You can buy a balanced mutual fund that will balance itself. You can also buy ETFs, and there's a couple of examples, XBAL and VBAL. If you want control, you can do it yourself and have separate investments. If you want no part of that, you can invest in one of these. They will tell you whether they're 60-40, 70-30, 80-20, and so you need to choose the right one. So that's a very good point. Okay, so rebalancing returns the portfolio back to the appropriate proportion by selling the assets that have a larger proportion of the portfolio than originally intended. So in my example, maybe at the end of the year, you were, instead of 60-40, you were 70-30, right? So you sell 10% off of the one that was higher than intended, and you buy the one that's the smaller proportion. It sells high, buys low for your portfolio, and it establishes the desired risk profile. And then, depending on the account type, rebalance. So RSP and TFSA, while you keep the assets within those accounts, you can buy and sell, and there's no tax implications. But with a non-registered, there would be. If you sold something, you would have to pay capital gains on it. So you could also rebalance by buying more of the thing that is low, and that way you avoid the capital gains taxes. Okay. Okay. We're sort of at an hour and a half, and apologies again for being late. Okay, why don't we end here? This is sort of a natural stopping point. I'm happy to hang out if anybody has any questions. There have been some good ones so far. The next session is going to be next Thursday, so in 2 days, just to kind of keep the train rolling. We're going to finish this off and get into some very exciting taxes, and TFSA versus RSP, which one to use when and what assets to put into which one. So that's going to be the next one. So I'll give you guys a quick preview. Different account types, And we'll talk about RSPs, TFSAs, which ones to use when. This is sort of an interesting chart of when you use TFSAs and RSPs. I would be remiss if I didn't trot out the tax table, so something to look forward to. And then we'll sort of talk about. Okay, well, let me just finish. Then we'll talk about personal finance, so stuff like mortgages and credit cards and stuff like that. Permanent life insurance in general, and so on. Can we sell in TFSA after a few months? So, okay, just to be clear, RSP and TFSA is an account. You can put assets into it. As soon as it crosses the boundary, that lowers your limit for the account. Okay. Once something is in there, you can buy and sell within the account without pulling the money actually out into your checking account. You can do that as much as you want. There's no tax implications. Now, if you bought something like mutual funds, I believe if you sell within 60 or 90 days, there's usually a disclaimer in tiny little letters when you're on the purchase screen of your brokerage. If you sell a mutual fund within 60 or 90 days, they'll ding you like 2%. That deferred sales charge, which is basically an early sale charge, they would also charge you if you sold the mutual fund then. ETFs typically don't have any of that. Neither do stocks. You would still be paying any trading commissions if any. TFSA, if you actually pull the money out into your checking account, if you deregister it, I believe is the technical term, your limit doesn't recycle until next January 1st. So an example with the TFSA, you have 6,000 fresh dollars at the beginning of the year. You buy $4,000 worth inside your TFSA, or even just transfer the money into TFSA and leave it in cash. Your limit is now $2,000, assuming all of your previous years are used up. If you sell whatever it is you bought, you would pay any commissions, any early withdrawals on that $4,000. But if you pull it into your checking account, you're not able to immediately buy, you're not immediately able to transfer it back in. You would be over your limit. Your limit will recycle January 1st, and then you would get the $4,000 or $4,050 or whatever. You'd get that January 1st plus a fresh 6,000. Okay, I hope that's clear. So can we sell stocks or ETFs within TFSA after any time I bought, and that will be without tax, correct? And no issues with the CRA. So I think I know where you're going. So you can certainly sell stocks or ETFs within the TFSA without any tax implications. If you pull the money out of a TFSA, also no tax implications. With an RSP, if you can buy and sell within the RSP, but if you pull the money out, then that gets added to your income for that year. So that has a tax implication. TFSA, because it's a tax-free savings account or investment account, there's no tax implication. But I think what the question is getting at is, can you day trade within your TFSA? And the answer is no. Our CRA will come after you, especially if you've made a profit. You can certainly buy stuff, leave it in there for a week. I'm not the CRA, so don't quote me on this. You can check with them. They might flag you for an audit, but you can certainly check with them. And but if you 3 to 6 months is not day trading. No, that's regular investment. But if you buy something in the morning and you sell it in the afternoon, that's day trading. and then they will say you have to pay taxes on that. This is supposed to be a personal account, and you're using it for business. You're obviously running it for to live on as work, because you're devoting your whole day to it. So no, 3 to 6 months. I'm sure you would be fine. I would even say if you buy something beginning of the month and you slide at the end, you're still fine. If you're ever called on that, I believe they look at other things. So for example, if you have a day job doing something else, then that's like, well, I'm definitely not day trading. So just confirm, I just can't do less than a week. We're okay with, I would say more than a month is fine. Again, I don't represent the CRA. Please check with them. But that feels like you should be fine. Day trading was the one that I understood was the problem, because then it looks like you're doing it for business, and then that's bad. Okay, good questions. Any others? All right, going once. Thank you. Okay. Yes, of course. Yeah, I've given this presentation multiple times. I've done lunch and learns for coworkers. Pretty much anybody that is interested in learning about investing, I'm happy to run them through this. I'm glad I'm able to do it for multiple people at the same time. And you know, that hopefully I'm getting you to become interested, to see that it's important, and to kind of get you towards whatever financial goals you have, whether it's retirement with dignity, whether it's early retirement, whether it's just financial independence, whether it's being able to tell your boss that you don't want to work there anymore, whatever it is. You know, money gives you options. It gives you choices, and I'm at the stage where I can live off my portfolio, and I'm considering myself very blessed and happy that I can do that. So yeah, I hope everybody is in a similar position very soon, and yeah, so I hope to see everybody on Wednesday. Sorry, on Thursday. Apologies, on Thursday in 2 days, on the 25th, same time, and it'll be a continuation. It's not going to be a repeat of this part of the presentation. All right, everybody. I thank you for your attendance, and yeah. Please do save up any questions as well for either next time or for the Q&A session, which is the 4th session, and that's going to be Tuesday next week. I wish you all good night, and I'll see you soon.